Hello and welcome everyone to this Super Return webinar in partnership with Palico, secondaries during Covid-19, what buyers look for in these uncertain times. So before we get started, I would like to remind you this is an interactive session and you can submit questions to our speakers using the Ask a Question widget on your screen. Please also note that this webinar is being recorded and will be available on demand afterwards. I'd now like to introduce Claire Commons, Head of Strategy at Palico. Claire, take it away.
Thanks so much, Adam, and welcome everybody to our panel discussion, which we hope will be both interesting and useful for you in today's world. So the topic we're going to cover today is really to think about what are secondary investors thinking about and what are they looking to buy. So I'm joined by investment leaders from three of the industry's most preeminent secondary firms, Coller Capital, VCFA, and Hamilton Lane. I'll introduce the panelists and provide a brief background of the secondary market, and then we'll spend the majority of the time talking about their investment strategies and how they're approaching today's market. And as Adam said in the beginning, there's going to be opportunities throughout for audience participation. So we'll have a couple of polls to take your temperature on what you're thinking about, and then at the end we'll leave some time for questions that you can submit directly through this webinar. So, with further ado, let's meet the panelists. So I'm joined by Andrew Reilly, who is co-president and managing director at VCFA Group. And I'm actually starting with him because VCFA was one of the earliest investors in secondaries and really, in some ways, pioneered the concept of secondary purchase of a limited partner interest. He can share a little more of the history when we get to him. But they have been investing in the secondary market since the 80s. They've raised 9 funds totaling $730 million with nearly 200 fund acquisitions, and their focus since the outset has been on venture and growth. I'm also joined by Francois Aguerre, who is the co-head of Origination at Coller Capital. Coller is one of the preeminent private equity firms dedicated to investing in secondaries. They were founded in 1990 by Jeremy Coller. So interestingly, their history does intertwine a little bit with VCFA, which we can get to later as well. They have headquarters in London, but have global offices and are one of the largest secondary investors. Their last fund, which was raised in 2015, was a little over $7 billion. And they really focus on everything from investing in LP interests as small as $1 million, all the way to large, complex GP restructurings, and will do transactions, individual transactions of about $1 billion each transaction. And finally, on the right is Richard Hope, who's a managing director and head of EMEA at Hamilton Lane. Hamilton Lane was founded in the early 90s in Philadelphia in the US and now is also worldwide with 16 different offices. And they are a diversified alternative asset investment management and advisory firm. So they do the advisory work, and that's about $480 billion of advisory assets, as well as discretionary investing of about $660 billion. And distinguishing, I'd say, them as it compares to some of the other strategies we'll hear about is really their focus on both investing in secondaries as well as primaries. So they started investing in primaries. They had their first fund-to-fund in 1998 and their first secondaries fund in 2005. So we'll hear from all three of them about how they use their unique strategy and perspective to invest in the market. And finally, I'm head of strategy here at Palico, and really why I'm talking to you today is because I've spent 20 years being a limited partner, so I have kind of lived through that and stepped in the shoes of limited partners and understand the liquidity challenges many investors face. So I've actually worked with endowments, Cambridge Associates, and pension funds at other investment firms and families as well. In fact, I actually first learned about Palico from a client that I was working with at a previous firm who was trying to sell their limited partner interest, but it was on the smaller end, so it was hard for us to get a lot of attention in a brokered process. And that's actually what led me to Palico. And so Palico is the online secondaries platform that connects limited partners with the largest base of institutional buyers, like some of the folks here on the panel today. And as I said, our focus is really on the smaller end of the market. Our sweet spot is somewhere around 20 million, but we'll do smaller deals as well. And really our advantage, our streamlined digital process is what makes things different, because it makes it more efficient and easy to attract attention from both traditional and non-traditional buyers. And the buyers themselves find that Palico can be a useful tool, because really by looking at stuff on Palico, they can see deal flow that was previously locked up because the sellers weren't, they didn't have a way of getting to the market. All right, let's set the stage a bit of why we're talking about secondaries. And on this first slide, you can see that private equity itself, which is what secondaries are, of course, invested in, are an important part of investors' portfolios. And actually, their importance has grown. So if you look at growth over time, private equity has grown eightfold since 2000. And why is that? Well, we're looking for outperformance versus public markets. We're looking for diversification. And we're just looking for market exposure as more companies stay private. So as we know, private equity is famously illiquid, and it takes 10 to 15, sometimes 20 years to completely wrap up a fund. And because of this, line items of individual funds in investors' private equity portfolios balloon over time. So you can have pension funds or endowments that have been investing in private equity for 30 years that have hundreds of limited partner stakes with some residual value, but the bulk of the value of the private equity is in a much smaller group of funds. So you can see here on this graph, we think about 760 billion of total value in some of these older funds. So the secondary market really has emerged as a great tool for investors to manage their portfolios in a more active fashion. So one of the reasons that you could use the secondary market is, as we just talked about, to clean out some of the tail ends, to kind of do spring cleaning on your portfolio. But you can also think of it as a way to dynamically shift among strategies within private equity, or just, frankly, if you need cash, if you need liquidity. So you can see that the secondary market has grown significantly over time, through thick and through thin, through various market cycles. So finally, the last slide here on our little preamble, as secondary market, as this tool has become more popular, there's been this huge innovation, this huge growth, this new sub-asset class within private equity. That's investment management firms who raise capital specifically to invest in these secondary opportunities. Actually, secondaries are the fastest growing sub-asset class within private equity. So with that growth, you can see now there are private equity firms that specialize in all different types of these secondary strategies, different size of secondaries, different asset classes, whether it's venture, growth, real estate, infrastructure, et cetera, or even age. Some firms, like tail end stuff. Some folks like stuff that's closer to primaries. So with that innovation, there's been a lot of capital raised, and so you can see over time there's been a fair amount of what's called dry powder or capital that these sophisticated investment firms have at their disposal to deploy. So now let's turn to the guests to talk about how they invest and how they're thinking about deploying some of their dry powder. So let's first kick things off by talking broadly about your investment strategies. And Andrew, president of VCFA, why don't you start, given your firm's history and the history of the secondary market itself is so intertwined. So why don't you share with us your firm's origins and how your strategy has developed. And before I start, I want to also offer my condolences for the recent passing of your founder.
Well, thanks, Claire. I appreciate that. And I agree. The origins of the industry, our founder and VCFA, and are all very intertwined. So I'll just give you a little background about the originations of VCFA, the secondary industry, and then that will segue nicely into kind of VCFA's investment strategy and exactly what we do. So VCFA was founded in 1982 by a gentleman named Dayton Carr, who, as Claire just said, recently passed away. Dayton founded the firm just after what is largely regarded to be as the first secondary transaction. In the late 60s, Dayton was had partnered with Thomas Watson, then chairman of IBM, to start a venture capital firm. So if you can imagine what Silicon Valley and venture capital landscape looked like in the 60s, there wasn't that much there, but the kind of seminal names today in venture capital were who Dayton quickly started to build relationships with. So Dayton liked to often say he was the reference letter for his two friends, Tom Perkins and Eugene Kleiner, and Kleiner Perkins one. And he wrote the reference letters to the Hillman family, largely backed that fund. So he was really there at the beginning of this, and he was operating a small venture capital firm for he and Watson. Well, long story short, in 1979, Watson got tapped by then President Jimmy Carter to be ambassador of the Soviet Union. And so here was this about 11, 12-year-old venture fund with 4 or 5 assets left in it, back in the days when we really held things at cost. And Watson was there needing to divest his personal investments as he entered the State Department. And he said, Dayton, why don't you buy the fund from me? And he gave Dayton a pretty short wick. But Dayton, knowing he had a highly motivated seller, was able to buy Watson out at a very good price. And that's largely considered the first time a limited partner base has ever been purchased out of a private equity fund. And that was in 1979. About 4 months after that transaction, a company called Crystal Technologies sold to Siemens for a big price. And that transaction with Watson ended up working out really well for Dayton. So Dayton abandoned plans to raise yet another venture fund and really developed the strategy of getting in later and cheaper into private equity funds because that had worked out so well. So in 1982, he formed VCFA and started with a series of very small funds throughout the 80s and was evangelizing the secondary strategy, which in his mind was really to purchase very high quality venture growth equity assets much later in their cycle and at a discount. And that strategy he evangelized and began to grow. And in the 80s, really up until about the early 90s, if you were a holder of a venture capital or a private equity asset of any kind and you wanted liquidity, you really had 2 choices. One was sell to Dayton or to not sell at all. And so Dayton was really generous with his time and explaining his strategy at that time. And to tie it into Coller Capital a little bit, one of his early investors was ICI, a pension fund in Europe, and there was a very bright analyst there who contacted Dayton, and ICI was a limited partner in 1 or 2 of Dayton's funds. That young man's name at the time was Jeremy Coller, and Dayton explained his strategy in the business to Jeremy, who then obviously the history of Coller Capital. And I could go on and on about a half a dozen names of folks who early on in the industry contacted Dayton, and Dayton was always very generous with his time and effort. I think he knew, he didn't want to be the only one in this industry. It would never grow. But I'll just, I'll end that as the history of VCFA and a little about Dayton, but I'll draw your attention to Adam Lay really captured the history pretty well in a recent article. I believe in the PEI Media website, and it's titled "The Man Who Spawned an $88 Billion Industry." It's a great article, and it's worth reading. And so anyway, our condolences to Dayton. We'll miss him very much. But about 3 or 4 years ago, Dayton, was really taking a close look at VCFA and thinking succession. So things at VCFA are moving as they always have, and our focus in terms of our investment strategy has changed very little. We're a little differentiated in our quadrant of smaller secondaries that focus in growth and venture assets, in that we've mostly focused on fund restructurings, complex transactions. I bet about 70% of our transactions fall under that umbrella, whereas only about 20 to 25% of the transactions fall under limited partnership purchases, and about 10% directs. So, fund restructurings have become, a real fast-growing segment within the secondaries industry. It's always been more of our focus and concentration. So as you can imagine with VCFA, there are a lot of firsts. We've spun out a lot of corporate venture capital groups starting, I think, in 1992 was a very interesting one where Dayton had helped Northrop Grumman set up a corporate venture capital group, only to in 1992 when the markets were a little bit turbulent, wanted to sell it, and VCFA purchased that back. So we've focused on mostly mature end-of-life fund restructurings, corporate spin-outs, things of that nature. But usually, we focused on the smaller end of those. So we focus on transactions that are complex, but typically about the 20, 30, upwards of. We just completed a transaction of $60 million. When we do those types of those size transactions, we're typically bringing in some of our LPs and some of our friendly relationships in the market to co-invest with us. So that's really our focus, is venture and growth equity assets. A little more differentiation. I would say VCFA, in contrast to some of our other peers, we think of ourselves, we call it bottoms up, but we're very company-centric as opposed to GP-centric. So we'll focus quite a bit on the companies themselves. And as you can imagine, the venture and growth landscape, about 2,700 funds, but really when you talk about the aged and kind of secondary ripe funds, we believe there's about 600 funds that are really our target audience, and a subset of that, a little more than half, that have high quality assets still left in them. So that's really where we focus, and it's really paid off pretty well because we find it to be a less crowded end of the market. Not only because of deal sizes, but because it tends not to be too many people who focus most of their attention on the growth and venture segment. So that's what we do.
Wonderful. Well, great. Well, I'm going to turn it over I'm going to ask a question to Francois next. But before I do that, I'm going to ask the first poll question, given that we've heard from one investment specialist in secondaries. The question to the audience is, have you ever invested in secondaries, either directly bought them or invested through a secondary fund? So what I'm going to do is I'm going to ask Francois a question, and then we'll kind of come back and look at the answers. So Francois, first of all, I apologize for butchering your name in a bad anglicized way.
That was perfect.
Apologies to that. No, it wasn't. But so at Coller, as we talked about, you invest in everything from limited partner interest as small as $1 million to much larger transactions, $1 billion in single transaction and GP restructuring. So do you do it all, or where does Coller specialize? What's the Coller approach to investing?
Yeah. So I think it is fair to say that we can do it all, but definitely we do not want to do it all. Today's market, the secondaries market, when you look at it, is a very deep market. As Andrew mentioned, there was an article about 88 billion. We're talking about a very large market where you can have an approach which is, and sometimes people have in mind that the big players are sort of hoovering the market, buying everything and anything, and very often with some leverage in addition to the equity investment, and then hoping for the better. This is not the way we approach the market, and primarily because we don't like the volatility which goes with that approach, because that creates significant cyclicality, we think, in the returns. So the way we play the market is to be, yes, agnostic in terms of type of investment, but to have a very origination-focused model, hence my job title, which is not very common in the industry. The job title comes from the fact that typically every year we deploy between 2 to 3% of the deal flow that we screen. So last year, 2019, to put in context, we screened almost 140 billion of opportunities worldwide of all types, and we invested only less than 3%. So the reason why we look at origination is because, and I can give an illustration with our Fund 8, which is the fund we are just starting to invest. What you're trying to do is you're trying to create some alpha in a market which is almost an ETF derivative of the private equity market. And so to create that alpha, we think that you can effectively be selective enough to decorrelate from the market. In the current Fund 8 that we're starting to invest, as I said, we've managed at this stage, for instance, to get roughly 60% of our exposure is with managers which went through the previous GFC delivering first quartile funds. And so why is that important in today's market? It's very important because the visibility on assets and on business plans is very limited. In some cases, it's non-existent. So being able to back the right GP in terms of quality is a massive premium compared to, again, spreading your capital across the market. We would agree with Andrew at Coller, which is that we are very also asset focused. We like our due diligence, sometimes being very, analyst heavy. But that is also important because when you look at the various sectors, and again, still in this Fund 8, we've got also 60% coincidentally, which has been invested specifically with technology and healthcare companies. And why is it important? It's important because those sectors are likely to go through the crisis with very limited impact on the portfolio companies. We've got many companies which are actually outperforming their business plan this year, 2020. So the ability to do that when you invest multi-billion funds, when you invest across thousands of underlying portfolio companies, the ability to do that relies on effectively a very intense origination work. So that's the way to think about it for us. It doesn't matter if it's small or if it's large, but it's more a matter of the characteristics of the investment and why the investment is likely to outperform a more traditional, diversified secondary investments. Hope that clears.
Great, thank you. Let's see if we get any results from our poll. So we have about 50% of the audience has some experience investing in secondaries and about half not, which that matches some of my experience. I was just looking at the numbers the other day that showed that, was it Preqin, showed that the proportion of funds by strategy, buyouts, fund of funds, growth, turnaround, venture, et cetera, that return less than a 1 multiple, so don't return your money back. Only 1% of secondary funds do that versus a third of venture funds. So kind of interesting. Could be an opportunity for some of the audience members to consider secondaries as a addition to their portfolio. I'm going to now turn to the Hamilton Lane approach. And Richard, I'm going to ask you a question, but I wanted to go to the next question for the audience, which is, who's been on the other side? Have you sold part of your portfolio or a position on the secondary market? Maybe to one of the groups on the panel. So that's the next question. But Richard, why don't I turn to you, and maybe we can talk about, specific to Hamilton Lane, I'd say as different from some of the other groups that on the panel, is you have both a primary and a secondary business. So maybe you can talk about how those businesses complement each other and work together and how that impacts your investment strategy.
Sure. Thanks, Claire. And hi, everyone. I thought the first question was pretty interesting there, that 50-50 the audience either have or have not invested into secondary. I think that shows, how much this has increased in either use by LPs or acceptance in the marketplace. So, I think encouraging to see, particularly as you build portfolios, that actually secondary can perform a tactical part of that. In terms of our own business, as Claire said, we have an enormous primary business, one of the largest out there. Last year, we committed about $30 billion into the industry. In terms of our secondary business, last year, investing just over $1 billion, and we've been doing that consistently on an annual basis. But the important thing there about the primary business is it gives us a huge amount of information. And so our positioning on the secondary is very much a data-led approach. So take the insight and really position yourself as an informed buyer with strong relationships. So we've got a database with kind of daily cash flows from more than 4,600 funds. It's really helpful, and so the guys have already talked about, their own positioning. One of the challenges we often have is we know too much, and so particularly in today's market, as you consider what's happening out there in the market, as we've looked over the past few years, as you've gone to underwrite portfolios and pricing has been going ever higher, sometimes having the information, doing the bottoms-up approach, has led us really to stay away from certain transactions. So we got a similar number to Francois in terms of the deal flow. So last year, about 140 billion of deals came through the door. So huge amount, tons of choice for this industry, which is really positive. And certainly, I would say one of the big areas where this industry has moved is the sort of greater acceptance by LPs, not only of investing, but also of the liquidity mechanism that's available out there. Back to you, Claire.
Great. Well, why don't we look at the poll results? Okay, so this does not surprise me at all that the majority of the people, the audience, has not sold, and I think that's not very uncommon. That you can be, and I played this role for many years. You can be have built multi-billion-dollar private equity portfolios, but have never thought of secondaries as a tool for active portfolio management. I think the thing here is that there's no house on fire generally, right? It's a tool you can use, and the worst that happens if you don't sell something is it just eventually runs off. I think the opportunity here is that when the portfolios become so large with so many line items, there does come a point at which it really does become prudent to think about kind of right-sizing your portfolio, and then thinking about a way to use secondaries in a more kind of active tool to rebalance your portfolio. Well, let's get to the present day, and I want to talk about what you all are thinking about, how you're doing your business, what you're bidding on, what you think is attractive, and to start that, we of course have to talk about price and volume. And so here's the next poll to the audience, and I'm being a little mean. I'm asking the audience to weigh in first. What is your expectation for pricing of things that will actually get done in the second quarter? And big discounts, middle, minor discounts, and you'll see I didn't even offer the premium to anything because I don't think that's going to happen. And there's kind of two pieces, right? There's the price and discount, but then there's the actual volume. So I'd love to kind of talk about that. So maybe we can start with Andrew at VCFA. We were actually just before the call started, we were all chatting about, challenges of doing diligence in the market today. Obviously, we're all digital, and here at Palico, we've always been digital, and actually we've seen an increase of interest and listings on our platform since the pandemic started, because I think we've always been really well positioned to deal with that. But needless to say, being in this environment now does come with challenges. So maybe you can kick it off, Andrew, talking about how some of the ongoing deal processes have either been smooth or not smooth, and what you've learned in the past few weeks.
Great. Thanks, Claire. Yeah, so I would say remote working took for us a little while to get used to, but I think we got up to speed pretty quickly. We're a small team, we're 10 people, so we don't have the challenges of many offices around the globe and things like that. So we got up to speed fairly quickly, and I think the pipeline during this kind of, now that we're deep into the COVID pandemic and what seems to be kind of a new market turbulent and challenged environment and recessionary period. It's very unique. So first of all, just to set the table, we see this as very different than the most recent crisis of 2008. We're not seeing sellers who have big and deep underlying structural financial distress. So we don't see that. What we're seeing and what we're acting on is where the sale is probably more of a special situation or a strategy, and perhaps this time, because of COVID and the uncertainty and turbulent markets, is maybe forcing that strategy to be pushed along, as opposed to really having the focus be on just price, right? And so I think that would best describe the deals that we have in our pipeline currently, and the one or two we've closed that I would call kind of post-COVID. But for our sake, and to really know that we're able to complete our kind of deep and complex diligence process right now, and the deal we've most recently closed was because we really knew the assets well already. So that was a big difference. If I think right now it would be a bit of a challenge for us to do a deep diligence on a for us larger transaction, because like I said before, we tend to be less GP centric and more company centric. So we really spend, I think, the lion's share of our time is with CFOs, CEOs of companies. Remember, venture and growth deals are highly syndicated. So, if you look at the cap tables of the deals that we're buying into, there could be 15, 16 venture capital firms in the companies that we're looking at. So we like to know that we're in good company, but a lot of times we're buying that from the lesser known or an individual investor into those companies. So we rely less on kind of the GP marks and go and value assets ourselves. That's hard to do in this environment because we can't get on planes and we can't do that. We are making do with Zoom and things like that, but we're really focused right now on bringing to closure a couple of the deals, and one in particular, a significant deal we've just closed. We knew 2 or 3 of the assets out of the 5 remaining in the portfolio very well because we were already invested in them. So I'd say we're looking for more of those opportunities right now, and still being very cautious about the pipeline and opportunities we're seeing, because we don't think this is kind of the full picture. We're kind of predicting that through the summer and through the fall, we'll really get a better look at how deep this recession is cutting. We do believe there'll be more turbulence in the public markets, which a fringe benefit to that is usually activity in the secondary markets. So we're 1 foot on the brake, very cautious. If we're looking at deals, it's things we can more easily diligence, or the underlying assets we really already know pretty well.
Great. Maybe I can turn it over to Francois. You mentioned the kind of deal volume that you look at, or you historically have looked at. Maybe you can comment on the volume that you're seeing your expectation for volume, and what types of things are interesting or are coming in within the Coller sweet spot since the pandemic has hit?
Yeah, absolutely. Happy to do that. So I think maybe to start with the volume as an estimate, when today you look at various publications, I think the latest one was going from Green Hill and showing basically anywhere between 25 to 75 billion of volume. So quite wide range of expectations, demonstrating that people do not really have yet a clear idea of how H2 will come. My personal guess would be that H2 will be quite busy. A lot of people will want to make it up for H1. And so I wouldn't be surprised if we end up around 50 billion. Sounds like, a pretty round number. I'm an engineer by background, so I would put my money on 50 billion. I think in terms of what we see today, it is definitely slower in the market. But there are opportunities coming across our desk in all geographies, and probably still quite active in the U.S. If you think about it, the U.S. economy has been the one least shut down in a way across all developed markets, and so therefore people are just more engaged in any type of business, including secondaries. What you see, however, is a number of binary situations. To Andrew's point earlier about the transaction that just closed, buying assets that you know well is a possibility if those assets are still operating. And what we see in portfolios today is that some assets continue to do well, if not very well, while other assets have stopped 100% of their revenue income. So in that context, you may know or not the assets. It's quite difficult. So what you see as mechanisms taking place in the market is how can we transact to provide some liquidity, to provide some solution without having to debate forever on valuations, because nobody have really a firm view on the valuation for some of those assets. So you see, pref equity instruments being discussed in the market. You see earnout mechanisms. You see also tailor-made waterfall put in place between sellers and buyers, and sometimes including the GP. So all of those structures are not structures which are of specific interest to the parties, but for the fact that they simplify the valuation discussion. So you do see a lot of that. In terms of the discounts, I'd be interested to see the results of the poll that you had there, because obviously, what discount are we talking about? Is it you said current NAV? Is it March 31st NAV? Is it December 31st? We've seen already, and I think it was also in the Green Hill report, something like 10 to 15% reduction across the board between December and March. And so obviously, a 10 or 20% discount to December is not the same as an equivalent discount to March. So those numbers are starting to come up, and discounts will widen compared to 2019, no question.
Well, you're exactly right. I did simplify the question a little bit because there may be some transactions that happen in second quarter based on 12/31 numbers and others on March 31. But let's see what the audience said. Okay, so I think the general feeling is that there'll be a pretty there'll be a discount to the NAVs that are currently available. Again, could be December, could be March. I would say, we'll see what happens, and I think a lot of it has to do with, as you just said, Francois, whether the underlying assets are ones that are pretty resistant to this. Obviously technology, healthcare, or service and real estate and some of these other industries that are going to be much harder hit. Why don't we now turn to you, Richard, and for these people that are thinking about selling, and I imagine because Hamilton Lane has both primaries and secondaries, you've probably been both a buyer and a seller potentially. What advice would you give to someone who is considering selling their portfolio now in terms of the type of asset, in terms of the age, the vintage, the amount unfunded? We just mentioned that, potentially if you offer an unfunded position, there's less bickering over price. If you were to put yourself in the seller's shoes, what advice would you give today?
I mean, obviously, just come and speak to Hamilton Lane and no one else. But aside from that, I think it's the key thing I would say is do not be seduced by the pricing that you saw last year. I think you do have to be realistic in this market. I think Francois has already commented on the reset evaluations that are out there. I think that's important. I think I would say to those sellers who are out there, consider carefully that the market's changed. I think back in 2008, really secondary was a market of last resort. And you really only sold on the secondary market if you had to. And I think what's happened with secondary over the last 5, if not 10 years, is it's become much more accepted liquidity mechanism for investors in private markets. And I think there's a lot of capital out there. There's a lot of choice in terms of opportunities, but also there's many sellers who can work in a structured way to achieve the objectives. And I think particularly in today's market where there's less certainty around on things like valuation, be clear as the seller what it is you're hoping to get. Are you hoping to free yourself from some of the future commitments? Or actually are you just absolutely looking to maximize the price? Depending on that objective will depend, frankly, what you can structure. And what you can come up with the opportunity set. So I think there's certainly plenty scope. The market is very much open. I think the guys have already commented that volumes are down this year. Volumes are down this year because of uncertainty from a valuation perspective. We do have much more visibility now on what's happening with the first quarter valuations. Second quarter valuations are unknown at this point. But at least you have a line in the sand of where valuations have moved from December to March. Come with your objectives and talk to the secondary community about what you're hoping to achieve.
Yeah, I flipped back to this page of the kind of the growth of the transaction market, kind of as you were speaking. We've referenced how things are different from the last crisis a couple of times, and I think that's a really important point to look at the maturity of the market as it compares with 2009, which was kind of the last low point. And I mean, even more recently, I think in 2015 there were, call it 30 kind of main secondary investment firms, and now there are more than 70. And so I think the market has matured. And the innovation and the customization and the specific strategies have also developed. And so there are buyers now for all sorts, all shapes and sizes of investment portfolios. So obviously, at Palico, we think that there will be, softening in terms of volume, but we do feel like it's going to be a pretty different dynamic than during the last crisis. Well, it's 15. We've saved 15 minutes for audience questions, and so audience, if you haven't done so, there is a tab at the bottom that you can type in a question and submit something. So this would be the time for you to do that. I would say maybe to kind of start this off looking at some of the questions is many of you have talked about doing bottom-up approach when you're analyzing these investment opportunities. What kind of challenges do you face in environment doing that type of analysis. And I'll kind of preface this by saying that I was speaking with Andrew was reminding me, kind of you talking about looking at individual companies. I was talking with a friend of mine who is a partner at a well-known venture firm, and he said basically it's good he is a good network because he'll do a deal. He'll invest in a company that he's met before now, but he's not going to invest in a startup that he's never met at this point. So for him, the real benefit is having a deep network, basically that he's already met so many people. So maybe you can, Andrew, you can start with how you're thinking about dealing with some of those challenges.
Yeah, it's exactly the same kind of concept in terms of if we know a company, if we know a management team and know that asset well, that's kind of at the top of the list of things that we would look at. And then you really have to make sure, the price is right. So we were recently able to buy more of a company that we know very well. We know that we have a good relationship with the CEO. Our representative is the chairman of the board of that company. And the company's it's having a record quarter and record year because it just happens to be in a space that is doing quite well in this environment. And believe it or not, it's not a technology business. We tend to be very heavy, tech and healthcare, but this is in the wine business, and people are drinking more wine than ever. So
no comment.
So that was an interesting one. But in general, I'd say if we have familiarity with the GP or the company or things like that, we'll, if there's an interesting transaction, we'll get there. We're spending a lot of time on Zoom with folks and things, but to get to final closure and things, is just such a big part of our diligence process that is, really touch and feel and really get to know, the underlying assets. So while I'd say you can do technology has presented itself such that, and we're getting better at it through this crisis. I think a lot of these practices we're developing will be great in the years to come. But I would say, it's a challenge for us to really make a significant investment and to really get it through all the facets of our investment committee process. If it's an asset we didn't know or we haven't been tracking for years. Now, just to break that out though, we look at about 200-ish transactions a year and we end up closing 5 to 7. So what that really translates to is we've looked at a lot of deals over the past several years, right? So just if you look at even just looking 24 months back, there's a pipeline of 400 plus kind of transactions we've looked at. To put it into context, about 15 to 20% of those is where we really got into a bit of a diligence process. So there's upwards of 50, 60 transactions that we've looked at in the past and went pretty deep, where we could, if those transactions were to pose an opportunity today, we'd feel pretty comfortable, kind of diligencing those assets on that same premise of you talking to your friend in the venture capital. We've met them before. We are familiar. We keep a pretty good database of companies, high growth venture and growth companies that we really like, right? And then, as I said, venture growth equity, highly syndicated. So for every company we keep in our database of high growth, really attractive assets we'd like to buy, there's a lot of different angles. There's 10, 12 GPs we could buy it through, directs, and others. So we, at any given time, we have enough of a deep bench of opportunities in our pipeline where we can transact. I would say it's the net new opportunities that present themselves right now that we'd have to wait. And we're being cautious. I think we're really waiting for kind of the June 30 marks to really define how we're going to put money to work for the rest of this year. So we have enough of an old pipeline and history of diligence where we can look at opportunities, But the net new opportunities, we probably are not going to close anything inside of June 30 if the opportunity presents itself right now.
Yeah, one of the questions, or a couple of the questions that came up is a lot anchored on June 30, which I hear a lot. Of course, we have no idea what the world will be like when June 30 valuations come out. There's another question that came up that I wanted to ask, turn to Francois at Coller, partly because you mentioned sort of volatility of certain strategies using leverage and how Coller tends not to do that. The question is, what is the impact of the current downturn on your actual existing portfolio? And we know historically secondaries have been very, very good performers. Maybe you can comment on how some of the current Coller investments are weathering the storm.
Yeah, very happy to comment on that. I mean, it's the private equity industry by definition looks at the future for investments, but also continuously needs to manage existing portfolios. So not surprisingly, like all GPs in the industry, we have conducted a thorough analysis of the existing portfolios, and what we are seeing, as I was mentioning earlier, on the back of some more granular selectivity of GPs, of sectors, and sometimes individual assets. What we're seeing is that the impact, so whether it's operational or financial impact, negative impacts on the portfolio, is at this stage actually reasonably limited. It's a more general comment which is important to make, which is why private equity outperforms any other asset classes. At the end of the day, it is an industry which is being able to select better assets and being able to produce better governance and therefore performance for many of the assets that the managers invest in. So not surprisingly, you should have in the end diversified portfolios which do better, and I'm sure they will continue to do better and outperform the S&P or MSCI, whatever index we need to compare to. But at this stage, that's what we're seeing in our portfolios. In fairness, because I don't know if that applies to everyone, but back to my leverage point, we are very, very attentive to the average leverage of the portfolio. We know factually that we are at least 2 turns below the market average compared to other secondaries in terms of leverage that we have in our fund across all investments. And so by definition, that means as well that we are less impacted by volatility of the market. Historically, we are a very low volatility performing manager. And we know that as well factually. So that obviously helps in times of dislocation.
Great, thanks. Well, why don't we give the last question to Richard at Hamilton Lane, and let's bring this back to technology a little bit. And you mentioned that, with your primary and secondary business, you are looking at and evaluating, thousands of different funds. How are you integrating technology in your due diligence process, and have you seen that grow as an important role with the crisis? How is that tool? How have the technological tools you've used evolved or increased since the outset of the crisis?
Yeah. So thank you. Happy to take the final question. What I would say, as a business, we've invested heavily balance sheet capital investing into technology businesses, so technology providers for private markets. So names that some of the audience will be familiar with, like iLevel, Cobalt, DealCloud, Canoe is the most recent one, where we've actually used money to invest in those businesses and then build bespoke tools for us. And that's hugely helpful today. So in terms of iLevel, the performance data, in terms of Cobalt, the benchmarking analysis that we can do, and DealCloud, really our CRM system, where all the information that we have on the portfolios is in there together with the new investments. We've talked to more than 400 GPs many times over the past weeks. All of those conversations are in our system. When we go to underwrite a deal, we have a model that essentially aggregates all of that information. So you go back 4 or 5 years, if we were underwriting an LP portfolio, it might take a fairly large team at least a week to do the initial first pass. Today we can almost do that on a touch of a button. Now clearly that's the top down, not the bottom up, but it really makes us a hell of a lot more efficient in terms of what we're doing, the information that we've got. And so this sort of data approach, aggregating the information in a sort of useful way is hugely helpful for us. We need to know what we're buying. We then also need to be prepared when we go spend time with the GPs. So we're negotiating something just now where, a year ago, the same thing was significant premium. Today, it's at a healthy discount. And actually, we've got all the tracks, all the conversations, all the company performance through that time. And so it really helps us in not only from a monitoring standpoint, but from a transaction standpoint in really following progress and really understanding and having conviction on what we're buying.
Well, we think that there has been and continues to be huge innovation at the intersection of technology and private equity. And we think that's super exciting. And, Palico, as I mentioned in the beginning, we are the online platform connecting LPs to institutional buyers. And for us, we're really using technology as an innovative tool to focus on the smaller end of the transaction size that makes things more streamlined and efficient, that, is great for sellers, whether they be first time or experienced sellers. And on the buyer side, there are all these potential deals that just, no one had seen before because they hadn't had a tool like this to come to market. So we're super excited to be part of that innovation and kind of growth of that advancement as well. Well, I'm just looking at the clock, and we need to wrap up the panel. And I thought it was a really great discussion and very timely, connecting with specific takeaways for the audience and really getting a deep dive into the minds of some of the most preeminent secondary specialists that on the planet. So I really appreciate and thank the panelists. And I guess the last thing I want to say is that I see that there are a bunch more questions. And unfortunately, we don't have time to get to all the questions. But if you are putting this on the page right here, that you can listen to our Capital Calls podcast and follow us on LinkedIn. And then finally, if you want to continue the conversation, there is this way you can put your phone right next to the screen. And I was shocked. I tried this myself. It worked. You can automatically book a time to speak more with us. So we'd be thrilled and honored to continue the conversation. So at this point, I would love to turn it over to Adam at SuperTurn, and thank you again to everybody for joining.
Brilliant. Thanks for that, Claire. And just echoing Claire's comments, I'd firstly just like to thank Palico and our panel of speakers for a wonderful discussion, and I'd like to thank our audience for attending. As mentioned, this webinar will be on demand, so I'd just like to say thank you again to everyone and enjoy the rest of your day. Thank you very much.
Thank you. Thanks, everyone.
Thank you.